Hello and welcome to our market alert video for today, which is Friday, September 8, 2023. And I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And I'm glad you're watching this video. Our goal for you is to have you become a SCWPS. And if you're not sure what a SCWPS is the acronym for Second Childhood Without Parental Supervision, which is what we call our clients who have retired and are off having fun and playing and not worrying about that parental supervision anymore. So thank you for watching this video. We've entitled this one, How the Deadly Duo Could Harm Us. And we want to talk about the two horsemen of the apocalypse, if you will, the Federal Reserve and inflation. And the combination of those two could cause quite a bit of damage to the economy and, of course, to our investments. So we're always want to be aware of what's going on there. Before we dive into it, though, I want to tell you I played tennis this morning, and I injured my back about a month ago. My body was feeling great. I was playing really well. And so I just overdid it, pulled my back, of course, why not? And so it's been a month. I've been getting therapy, thought it felt good. So I went and played. And after about 45 minutes, I thought, you know what? I probably should listen to my body and stop. So I did. So I think I'm about 65% there. Have another probably 2 or 3 weeks of rehab and rest and hopefully it'll be ready to go then. It's killing me, though, especially with the U.S. Open on television. It's like, golly. But anyway, let's talk about the not the dynamic duo, that's Batman and Robin, but the deadly duo, inflation and the Fed. Now, we anticipate that on the 13th, when inflation numbers are given to us next week for August, that we're going to see inflation heat up again, head back towards that 4% that we think it's going to head to. And of course, we've been talking about how that would not be very well received by investors. We've called it the inflation shock. And we thought that that would bring a correction. And of course, it already has, where the market from its peak was down about 6%. We think it might go all the way to 10% and be a full-blown correction. However, having said that, we do think that the Fed will get inflation under control next year. And the anticipation of that will encourage investors to buy in on the correction dip. And so we think that by the end of this year, the market should be higher than it is today. And the reason why we could get a correction or have gotten a correction, and it could get worse, is because if the Fed keeps interest rates high, raises interest rates, that causes companies to have to spend more money to borrow. Their cost of money goes up. And that's bad for profits. And we think profits drive stock prices. So that's a reason. And then, of course, if inflation is high and interest rates are high, the consumer doesn't spend as much. And then if that happens, then profits are also affected. So the combination of all of that could be another deadly duo. And so because of that, we think that there might be a recalibration here when we get the news next week, but we don't think it's anything to be overly worried about because of what I just said. So we think by the end of this year, the market should be in good shape with a hole in the middle as we jump over it. Now, on the bond side, we still are not counseling our clients to be in bonds. Again, why? Because as interest rates go up, bond prices tend to fall. And as we've seen so far this year, we've been out of bonds since April of last year. And of course, we've seen how badly bonds have been beaten up during that period. So we continue to say that we should be in cash on our bond allocation. And right now, money market funds are paying over 5%. So why not get paid 5% while you're waiting? Not bad, with hardly any risk. So overall, we think that we'll be probably going back into bonds in April-ish of next year as the Federal Reserve comes to the end of this whole interest rate cycle, and we think that's when it'll be. So overall, things are coming about as we thought. Correction, recovery, inflation, not in bonds. All those things are the things we've been telling you for several months now, and it looks like they're all coming to pass. Now, if you're not a client And certainly we want you to be. We want you to become a squipper, of course. And so our website is rpoa.com. If you meet with one of our retirement planners, we'll build for you a retirement plan and hopefully get you to where you can retire, become a squipper, or maybe retire, stay retired if you're already there, right? We want your money to last as long as you do. And as we always say, we're not here to make you rich quick. We're here to keep you from becoming poor. And there's a huge difference between those two. And I think you know what that difference is. So we look forward to visiting with you and seeing if it can be a good fit. Share this video with as many people as you want, as you would like. We'd love to help as many people as possible achieve squipperness. I just made up a new word. So thanks for watching this video, and we'll talk soon.